Australia Day, a significant day in this very challenging time to commemorate the resilience of small business leaders to what is now known as the new norm. Welcome to Business Insights, where a panel of industry thought leaders from a business advisory level, tax, risk management, property, superannuation and investments, employment and HR give their insights into the current economic and financial landscape that impact small to medium businesses around Australia during this pandemic and beyond. My name is Lisa Garrido, and I will host this morning, introducing the panel of small business leaders today in their area of expertise. Good morning. Welcome, Adam Lysle from O'Brien Palmer.
Good morning, Lisa.
Hello. Ian McLaughlin from Imperium Accounting and Tax.
Good morning, Lisa. Glad to be here.
Thank you. Sammy Qureshi from Money Clip.
Hi, Lisa. Thanks for being here.
Rob Skeen from Oasis Skeen Property.
G'day, Lisa. G'day, viewers. Thanks for having me.
And Bernard Tusimau from MGA Insurance.
Morning, Lisa. Morning, guys.
And yours truly, Lisa Garrido from Enigma HR. Adam, you're up first with the announcements that took place last week. What does that mean for SMEs?
Yeah, well, as most people should be aware by now, the Australian Federal Treasurer came out and confirmed that the Australian economy is in fact in recession. What does that mean? It means that the economy has been in 2 consecutive quarters of negative growth. At the moment, the estimations are that the negative growth will continue for the next quarter. So we'll have 3 negative quarters. The trick will be how quickly the Australian government can react to prevent it going into the 4th consecutive quarter of negative growth. And that also means, in effect, that we could be heading into a depression. Now, the reality is, what does it mean for business? Well, when we had our last recession in 1991, I think I mentioned this on the Business Insights a couple of weeks ago, we had 1.4% of negative growth. And the forecast at the moment, released by the Reserve Bank of Australia and by the Australian Federal Treasury, is that the negative growth is estimated to be around about 10%. Now that is really where it is going to hit us hardest. 10 times the negative growth that we had in the last recession is going to provide a very unstable platform for the Australian economy, remembering that 90% of all tax-paying businesses in this country are from the SME sector, people who are watching this right now. And that really means that people have got to get in touch with the people that are giving them the best advice. My point with this is, you know, the likes of Ian McLaughlin, Bernard Tusimau, Rob Skeen, Sam Qureshi, and of course you, Lisa, you are best placed to give businesses real advice dealing with the real issues of what they're facing today. And the important thing is that they've got to do that today. If they have not done it before COVID, if they haven't done it during COVID, please do it today. You really do need to know your numbers, because if you don't, you are setting yourself up for failure. Why do I say that? Well, in 1991, when we had the recession we had to have, we had a 27% increase in insolvencies. And we've got a recession now that is forecasted to be 10 times as bad. So you don't need to be a rocket scientist to work out that there's pain to come. The time is now to talk to your accountant and your bookkeeper to make sure that your numbers are real, they're relevant, and they're making sure that they're done in real time. If your accountant or your bookkeeper are giving you numbers that are for the financial year ending 2019, or worse, the financial year ending 2018, please stop that, because they are irrelevant to you now. You need to be forecasting for your security to make sure that your business is going to be prosperous during this period. And if it is, if it's in a position of strength, then you should be getting good advice, financial advice from the likes of Sam, to take up opportunities for merging and acquiring other businesses and actually growing your platform during this period of time. All of these issues will be played out in the coming months, but I'm fearful that we're heading in the wrong direction, because the next quarter of negative growth has already been tagged by the Australian Federal Treasurer in his announcement on Wednesday. So it's not going to be great moving forward. Let's just be real for a moment, and I hate being the bearer of bad news. If there will be businesses that will fall over. There already has been as a result of COVID. It's only going to get worse. There are big sufferings in the retail, hospitality, leisure, transport and logistics, business services sectors. There will be more pain to come. If anyone is in trouble, now's the time to get that advice so that you can make sure, at least if there is going to be a need to change tact, you can make sure that you're protected, because there are a whole pile of ramifications if you do it, you try and do it yourself. I've heard of this week someone going down to the pub because they could on the weekend and talking to their mates. Oh, don't worry about it, mate. Just shift your assets from here over to here. You'll be right. Guess what? Not only can that person be in trouble for acting illegally, but the person that gave them the advice, particularly if they're a professional, is actually breaching the law as well now. So get good advice now, stay strong, make sure your numbers are real, and hopefully you can get through the other side of the recession stronger and better and staying in business, and that's the goal.
Thanks, Adam. Look, we're really going to be looking forward to a lot more of your input and advice in the coming weeks on that basis. You know, probably some good tips for us to know about for next week. Just keep that in mind. And for our viewers, keep that in mind. We are broadcasting every Monday at midday, and these are the issues that we talk about. Now, Ian, you've been really busy with JobKeeper throughout this period. So what's the latest in JobKeeper and cash flow tools?
Yeah, thanks, Lisa. So for businesses that are going to make their monthly declarations to receive their JobKeeper payments for the month of May, those opened up on the 1st of June, and the ATO will close those off on the 14th of June. So there's really only another 6 days that they have to either go onto the business portal or get their accountant to go onto the tax agent portal and make those May declarations for them. So it's really important that they get done in time, because after the 14th of June, you can't get paid for May. Now, just another important point about JobKeeper is that the government did extend the deadline. So businesses that will end up qualifying for JobKeeper in June, they have until the end of June to enroll for JobKeeper. They won't then receive their first payment until July, because they will make their monthly declaration from the week beginning the 1st of July. Another really important update with the cash flow boost is, so this was the credits that the ATO was going to levy once businesses had lodged their quarterly or monthly business activity statements. Now, these were due at the end of last month. The ATO has finished finalizing 95% of the cash flow credits. There's still another 5% to process. 3% of those are being looked at for their eligibility tests, and the remaining 2% are just the ones that are still trickling through the system. So if you haven't received your cash flow credit boost by the end of next week, I would be contacting the ATO and finding out what is happening there. Lisa, just another important point, something that we're doing with all of our business clients. You know, it's already the 8th of June. We're only 22 days out now from the end of financial year. So we're heavily in the thick of tax planning seasons for every single one of our clients. So that's really important that you make sure you know your numbers before 30 June, work out what the tax liability is going to be, and then see if there's anything that we can do to reduce that between now and 30 June. So Lisa, that's it for me today. Thank you very much.
Thank you. That's a lot to absorb. Great tips. Thank you, Ian. Sam, what about you? How's the market responding to the news about the official recession?
Yeah, it's actually quite interesting, Lisa. Last week, in fact, was a very high week. We ended up 4.2% up for the week. It's 6 consecutive increase since towards the end of March. And banks in particular led that staged recovery, which is amazing when we hear about things to do with recession. Right now, we're 10% shy of the calendar year high, which, as I said, you know, going into recession, not coming out of recession is amazing. And as I have mentioned before, who knows when we're going to get back to that 100% of activities pre-COVID, which, you know, is giving this particular optimism. it's interesting for everyone to know that, you know, a term that you're going to be hearing a bit more going forward is a term called revenge buying. Revenge buying is when there's pent-up demand, and and that gets released by, you know, going out and getting some retail therapy, basically. Obviously, that's been released at the moment, but will it continue into the future? Well, it's anyone's guess, based on what Adam was also talking about. Obviously, money is going to be tight, so we may not see that for that much longer. So we really need to make sure that there's this approach to this fan optimism is approached with very much caution. That real effect we won't see, as Adam said again, until a little bit later, and the impact of that and the magnitude of that compared to the last recession is massive. At the moment, nothing is more telling than one of our key fund managers just recently announced, in fact last week, that they've moved 50% of their investments into cash, waiting for a second leg down. So obviously that's on the proviso that obviously with things to do with the recession not getting better soon. In time they will, but not as yet. They've certainly been right many times before. They've performed really well, so I think the prudency that they're showing is well worth taking on board. And you know, there's a saying that says, you know, you buy in the dips and accumulate. So and I think that's really good advice for anyone who wants to be in the market. Now, having said all that, though, picking up on Adam's point, even in recession, there's money to be made in markets, and there are some more recession-proof industries. Consumer staples like supermarkets, technology-based businesses, and utilities, they tend to still be better recession-proof industries to invest in. So if you're looking at that, mining and financial companies, they'll remain a lot more volatile because they're more affected by the day-to-day activities, and any new piece of news that comes out, that tends to affect those types of businesses much more. So overall, I guess, you know, the real trading is still quite thin. Things seems to be on the way up, but we need to be very mindful and cautious going forward.
What about an update on interest rates, Sam, and the banks?
Well, last week we saw RBA hold the rates at 0.25%, and they've cited that would be the floor that they're going to maintain for the time being. And in fact, we saw the result of that going into the Australian dollar. That rallied about back up to almost 70 cents, which is good for some, not so good for our exporters. A key trend that's going to continue to build with the bank is around valuation, though. I think that's a really big piece, because and this bank valuation is different to what Rob, for example, might talk about from a market valuation perspective on what happens in, you know, the transactions occurring. So on the bank's side in particular, there's a lot more conservatism being built, and valuations are coming in soft, especially for refinances. So I guess a water warning on that is that, you know, you need to be mindful that even though there's low rates, it doesn't mean that you can refinance your loan, because the valuations may not hold up to be able to use it to lender. At the moment, the lenders have sharpened their variable rates a little bit since a couple of weeks ago. So they're about 0.04 and to about 0.06% cheaper. A good variable rate nowadays, it sits about 2.65% per annum. A 2-year fixed rate at 2.09 and 3 years at 2.14% per annum. I've even seen a very competitive 5 years fixed rate at 2.54%, and again, that's a first for me in 15 years in the industry. But one thing I wanted to very briefly touch base on, I'm sure Rob will touch base on this in his discussion, is around the 25k stimulus package for renovation. Really great initiative to have, but last time we had something like this was basically the pink bat issue came out of it. So you just need to be mindful that if you're going to go down the path of doing any renovations, obviously the banks are interested in knowing they're using reliable builders, but in particular for your own peace of mind, make sure that you are vetting the builders really well, getting references, and look at the other work that they've been doing. So then you know that you're not going to get a shoddy builder doing it.
Sam, thank you for that. Lots of things to think about, and very much links to you, Rob, in terms of the news last week about the Home Builders Grant. So tell us about that, and also some tips, I suppose, for commercial tenants struggling to pay the rent.
Will do. Thanks, Lisa. And You know, you guys are so awesome. I love your passion, Adam, and really sobering news that's come across this week. But yes, I'm happy to answer those questions. First up, last week, Domain Group recorded 313 property auctions with a clearance rate of 57%. Now that's down on last week's 62% clearance rate, and I think that shows that the confidence has been dented with news of the Australian recession. In light of the recession, the government want to keep our construction industry going, and they've rolled out what Sam mentioned, the Home Builders Grant. $25,000 of free money available only for new home builds where the property value does not exceed $750,000. So it's not going to really help too many people in the city part of Sydney, but certainly outside of the metro areas, I think they're going to really take advantage of that. Renovations of people's homes valued between $150,000 and $750,000 are available for the 25 grand, but only if your property doesn't exceed the value of $1.5 million. A few more points to be eligible for the money. The contracts must be signed between June 4th and December 31st of 2020, and construction must be commenced within 3 months of that contract date. Furthermore, you must be an owner-occupier earning no more than 125K as an individual, and as a couple, no more than $200,000. Now, commercial leasing, if you are a tenant and you're struggling to pay rent, you are allowed to negotiate with your landlord. So for example, if your income has been affected 50%, you're 50% down on this time last year, and you can take those figures and present that to your commercial agent and landlord, you're in a position to get a 50% reduction. However, half of that will be payable to the owner over the term of your tenancy. So if it is a 50% deduction, you'll get 25% that you won't have to pay back, but 25% you will have to pay back over the life of your tenancy agreement. Now, we've got a case with one of our rentals, our commercial rentals, where the dentist has been closed. Obviously, over the pandemic, he's had a 90% reduction in his rent. Joke of the week. When your neighbour loses his job, it's the recession. When you lose your job, it's a depression. Thanks, guys. That's all from me.
Oh, thanks, Rob. That's excellent. Now over to you, Bertie. So how are small businesses going to manage their risk now that everybody's spoken about a lot of risk that we're all exposed to? Tell us about an update.
Well, thanks, Lisa. Over the next week or so, you'll obviously see the continuation of businesses reopen, businesses return back to work, and what the new norm looks like, we're not entirely sure. I spoke in the previous year's week story about saving costs around insurance, and when money is tight and businesses are doing it tight, insurance is generally one of those things they look at and see where they can cut costs. And last week I spoke about exposures that you are able to self-insure. So we spoke about contents insurance and stock insurance, where limits to say $5,000 or $10,000, and policies and exposures that you're not, you are exposed to, but you're not sure what the value of those exposures are going to be. So things such as liability insurance. So during this pandemic, there is going to be a need and a want for people to try and cut insurances. If you do have a management liability insurance and a directors and officers insurance, this is the time not to cancel that insurance policy. It's quite an important insurance policy to have. Adam and Sam spoke about the recession and spoke about, some of the, things that are going to happen over the next, quarter and the next month and so forth. Directors and officers insurance is very important. As a director, you're exposed, to a lot of liabilities. Exposed to your company itself and other directors in your business, exposed to other shareholders in your business. You're exposed to regulators such as ASIC and APRA. You have exposure to employees, creditors, competitors, and consumers. Now, we spoke about employees, and Lisa, I know you'll touch on it this week, but it's important to have a management liability policy, which also includes employment practices liability. Now, you as an employer have a lot of obligations to an employees. Basically, what the employment practices liability covers is those types of claims that arise from the employees. This might be things such as harassment, bullying, unfair dismissal, especially during this time during COVID-19. Unfair dismissal is probably one of those things that will come up. These types of exposures will be covered underneath an employment practices liability policy. So it's important for you guys, and I know this is a takeaway for this week, I'll keep it short, is that although you are trying to save money, please make sure you don't cancel your management liability policies. If you do not have a management liability policy, please speak to your advisor and try and get one in place. It's not a cheap policy during this time. As you can appreciate, the exposure is real and the exposure is high, but it is very important that you try and shift these exposures to insurance policies. Thanks, Lisa. That's all for me this week.
Oh, thanks, Bernard, for touching on that, because I'd like to really cover some of the areas that you spoke about, because from an HR standpoint, we have essentially been forced into the world's largest work from home experiment. In about the last 10 weeks, a lot of businesses actually struggled with getting their workforce to work from home and to implement that. But now I think most businesses have transitioned to that. There's some research from Gartner research that indicated that 64% of professionals can actually work remotely now, and 63% of small businesses have decided to make changes and have a completely remote workforce. That is a staggering amount. There is still about 30% expected increase though, and demand to work from home. Employees are asking for more opportunities for flexible work arrangements. But interestingly enough, despite that, only 71% of businesses have actually got remote work policies. That's a staggering amount and staggering percentages that actually call for massive changes in any business's HR infrastructure, because essentially your business operations have changed, and they've changed considerably in the last 10 weeks. So what I'd like to cover today is looking at challenges that businesses need to address that revolve around the working from home scenario, which is really the new norm, what we now call the new norm. The first one is to maintain engagement and productivity with your teams. Potentially now, as a lot of businesses have staggered work hours, and some staff members or team members work from home and others returning to the office. So using ongoing and relevant communication tools and strategies to keep in touch is so essential. The second thing is to provide effective people management. Your managers now have to be trained to communicate and deal with difficult conversations and managing people remotely, which is something that we've not experienced before because they've always been visible, or your team members have always been visible. So train your managers to recognize success more genuinely, recognize where people appear stressed or are struggling. There are heaps of online training resources because businesses now have adapted to online training and technology. And these are low-cost training resources that all businesses have access to now. The third thing is to address your workplace health and safety risks, both psychological and physical risks. There are a multitude, and Bernard would know this, a multitude of workers' compensation risks businesses are exposed to now for any COVID-19 related anxiety and physical vulnerability. But you also need to be aware of any existing mental health issues or conditions that we may not have known pre-COVID with regards to our staff. So get to know your staff a little bit more. Provide assessments and ergonomic injuries and desk setups. Make any adjustments you need to make to manage their workload from home and let them achieve a work-life balance whilst managing their personal responsibilities that they have. So whilst these changes are occurring at a rapid rate, it does not give us in small business blanket justification to neglect our legal obligations under the National Employment Standards, under the Modern Awards, and definitely and under discrimination. The Fair Work Commission has accepted multitudes of claims under adverse action risks, basically from employees claiming discrimination in the workplace. So just to wrap up, and this is what everybody's been saying today, the latest research from Small Business Australia shows that 1.8 million Australian small businesses feel the added pressure due to COVID-19. And out of this, almost 47% have seriously considered closing down. Yet, good news is 74% tend to bounce back after a hard and stressful time like this. And their resilience is attributed or defined to how they tap into the resources and tools for support. This is exactly what Adam's saying, what Bernard's saying, what Rob and Sam have been saying, and same with you, Ian. It is more essential now to seek advice and support from the right individuals in HR. Understand what flexible work arrangements really mean and the additional requirements to work from home that you actually need to put in place for your business. Start looking at best practice initiatives because we're in this for longer term. That's it from me. Thank you, everybody, for your input this Monday morning. Do we have any questions that we probably want to raise with each other as we've been talking? I actually have one question for you, Ian, as you were talking about JobKeeper. I know that the JobKeeper provisions will be until September, and you always talk about a delayed payment for all businesses after we lodge the month's BADs, I suppose. For the month of September, is that the last month we actually physically receive the payments, or is that the last month that we lodge the reports at the end of the month?
Yeah, good question, Lisa. So JobKeeper gets paid right up until the 27th of September, and that is basically the last fortnight. So after that, the ATO will open up the applications to be paid for the month of September. So I'd imagine that it will probably run to about the 10th to around about the 12th of October. And most businesses will receive their final payments in between those dates.
Yeah, that's good for small businesses to know, particularly as they look at the real-time tools that Adam's talking about in terms of the cash flow forecasts. Do we have any other questions from the panelists?
I do. So question there for Sam. I mean, obviously, Adam was talking about the pains yet to come, and Ian was talking about JobKeeper be coming to a close. It's just interesting that the share market seems to be on the increase. What do you think that is with all this sort of looming? You know, JobKeeper's about to end, pains coming in the future. What's going on there?
Well, the share market is always forward-looking, so and often it's looking forward to, for example, to 2021, 2022 right now. So right now, the optimism is around the fact that things are going to get back to normal, and that we're going to be back to 100% of what it was in the past, and as a result of that, essentially, people are more attracted to trading in the share market and also increasing those as they go. Of course, in the flip side of that is that some people do have a short-term view. So the short-term view is that things are going to go great. Future's not here yet, so we have to wait till the future a bit more to work out whether this is actually a false dawn or not. And that's a term that you might hear as well. That essentially things look good, smell good, but in reality, not that great at the moment. So, and often you get that with a piece of fruit, for example. It can be rotten in the core a little bit, but on the outside still looks okay. So, I think this is very much a reaction of basically that optimism that everyone really wants. And obviously every piece of good news that you get seems to be that, yep, things are going to get back to normal. But there's the real mechanics and, all the nuts and bolts underneath that still need to be, fully greased up and work really well. And I think that's the bit that, we just need to be a bit mindful of to make sure that that is the case. And time's going to take for that to work its way through. As Adam said, a 10% number is a massive number. Most of us haven't experienced that in our lifetime. So I think we need to be very cautious.
Hey, Sam, I do have a question for you. I would be, and it sort of goes on with what Rob was saying, what he was asking about. I'd be really keen to find out how the futures market is reacting in this coming week. Because that will tell, like you just said, it'll tell the real story as to where the stock or the sophisticated investors see the market moving forward.
Yeah. I can definitely tell you that as it stands right now, the futures market is looking to increase in the coming week. And again, you know, when you think about everything that's happening around this bad news coming out, all the issues in US, you know, COVID-19. In fact, if you look at the graphs for COVID-19, they're actually on the way back up. So so it's quite interesting that, you know, we've seen past all those things, or we're not taking those into account in real life, and have this, you know, overall optimism that, you know, things are just going to get back to normal. But real work needs to be done for that to actually occur. And I just don't think that we're there yet. And I don't think we'll be there for the rest of the year, at least, because, you know, real hard work needs to be done to get back to the pre-COVID era.
It's interesting you're saying that, Sam, because definitely from our experience, the fact that employees are actually asking for this psychological safety to return to the office. And that's the reason why there's going to be a 30% increase in demand for working from home. And it is because of the easing of restrictions. And as we get back to this new normal, I do believe that more and more employees and team members will be asking for flexible work arrangements, which really, from a legislative perspective, only a handful of individuals qualify because they are in the protected categories for flexible work arrangement. But it's more widespread now, and it's been widespread, you know, in the last 10 weeks. So there's going to be a huge demand for working from home, which hopefully, Rob, you could give us an input in terms of the impact on commercial real estate, you know, in the next coming weeks. That'd be very interesting for us to actually see the statistics on that. I have one question for Bernie. Now, from your experience, how many businesses have actually reduced their insurance in terms of the directors and officers and public liability or management liability risks? I just find that astounding that businesses would actually cut down on those insurances.
Yeah, Lisa, great question. I touched on it last week. The broker report suggests that SME brokers have reported a downturn or 67% of brokers have reported a downturn in income. You know, my business itself, Lisa, you know, we are quite busy at the moment, but we're busy reassuring customers, you know, about their insurance policies and advising. It's not so much what we call income generating type of businesses. So we're not really putting in place new types of policies and things like that. If anything, you know, clients are reducing their insurance risk. And basically, you know, what that means is they're being exposed to unknown liabilities. And I keep talking about directors and officers and management liability insurances, you know, things such as your assets and, you know, stock and content.
Sure.
You know what you're exposed for when something goes wrong. There's a fire, you know, you've got $5,000 or $10,000 worth of stock you're exposed to. Whereas things such as, you know, employment practices liability, directors and officers insurances, you know, you're not sure how much that's going to cost you, and you're not sure, you know, what the liabilities are there. And, you know, given these, you know, testing times, this is when these insurance policies will be tested. You talk about directors and officers, you talk about insolvency and businesses becoming insolvent. As a director, you know, you're being exposed, your personal assets are being exposed to your decisions as a director. You're exposed to something like 436, you know, stat laws and you know, that's a lot of exposure. You've got basically a lot of exposure as a director, whether you know it or not, you just do. And, you know, it's quite important that you make sure your insurances are up to date, and it's quite important that you have a directors and officers or a management liability insurance policy in place.
Thank you for that. Thank you, team. Thanks to our panelists for spending time in our public holiday, enjoying our day off. But we do this for our visitors, our guests. We do this every Monday at midday. Business Insights. Have a good day and have a good rest of the day off. See you later.
Bye, Lisa.
Bye.
Bye, Lisa. Bye,
Thanks, guys.
Thank you.